disclaimer, and this is on our website, so if you want to read it in detail, it's lower, but basically Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurate. Actual profit or loss may vary due to market factors, liquidity, slippage, and commissions. So with that, I'm sharing my desktop and let's do an introduction. So today on the roundtable we have Greg Harmon, his author, and Jim Riggio, partner with Discussions, is with us on the panel. Jim and Greg are both managing money. I know, Greg, you have Dragonfly Capital, and Jim's with Highland Financial Group. And it's a pleasure to have you here today, Greg.
Thanks, Tom. It's good to be here.
So what I'm going to do you want to talk a little bit about your background before you get started?
Sure. I've been in financial services, trading businesses since 1986. I did get to see the October 87 crash. Spent time at JP Morgan when it was Chase Manhattan Bank, a lot of time up in Boston at State Street, and then at BNP Paribas trading equity derivatives right up until the financial crisis. At that point, I started my own business, Dragonfly Capital, which we can talk more about later. It's a trading service and a newsletter. And then last year, with a couple of partners, started a money management firm, Presidium Capital.
Fantastic. Well, I have given you the presenter, so you should be able to see a big button on your desktop called Share My Desktop.
And let's try and get this big now. Some of you may know that we talked a little bit about my business, Dragonfly Capital Management. I am a technical trader. I trade a lot of options, but I trade a lot of stock as well. And Tom had asked me if I could talk through the process that I use. And I don't like to just talk through theoretically. If any of you have read my book, there's a ton of examples in the book, and we're going to go through a couple of examples today. So really some applied technical analysis. I got my own disclosure, but I'm not really sure what it says, so we'll just keep moving. The process defined in my book, Trading Options Using Technical Analysis to Design Winning Trades, is one that I use every week and have been using every week for many, many years. So it's a process that works for me. It's not going to work for everyone, but it's one method for discovering trades and then learning how to trade in and out of positions that you might want to consider. I said that I am a technical trader. There's many other ways to discover and to determine trades to take, fundamental analysis, quantitative analysis. I use technical analysis. If you are versed in technical analysis, then you also know that there are many different forms of technical analysis. So I'm going to start with a little bit of background as to how my process works and how I apply technical analysis to determine stocks that I want to trade and then create options overlays on top of them. And I think the process of technical analysis comes down to some questions on the screen and some characteristics on the screen. And really the use and the reason for using technical analysis, there's three of them listed here: trend identification, looking for opportunities, defining risk. But it really comes down to being prepared. You want to be able to react to stock price movements based on what you know from the history of stock price movements. And that's what technical analysis really is. So being a top-down technician, my process starts with identifying the trend and then assessing the risk to the trend. And once I've got that set up, then I'll look for opportunities that go with the trend, and specifically ones that create a mosaic of different types of technical analysis that all point in that direction. Then finally, I'll add the options principles to the top of that to, as it says here, enhance, leverage, manage, and define risk. But I think the most important 3 words on this slide are create the plan. For me, creating the plan is writing it down. It's making it so that it's a mechanical process, so that in the heat of the battle, when your stock is moving 15 points against you in 5 seconds, you know what to do because it's right there in front of you. So if you take one thing away from this talk this afternoon, have that one thing be that you need to have a written plan in place that can cover any scenario that you can think of before you trade. In terms of trend identification, I said again, I'm a top-down technical analyst. So what I'm looking at is the S&P 500, the NASDAQ 100, and the Russell 2000. And being a stock trader as opposed to a futures trader, I'm looking at the SPY, the Triple Q, and the IWM, the ETFs that mimic those indexes. And simply looking for which direction they're heading. Are they in a consolidation mode like the IWM is right now and has been for the last 6 months, or are they in an uptrending mode like the SPY and the Q have been? The next step then is to look at intermarket influencers is what I call them. And if you step back and think, well, what could change the direction of the trend for the spiders? Well, changes in gold prices on a fast basis could do that. Changes in oil, bonds, the dollar, foreign markets, changes in the volatility index. So I look at each of those as well and put some bit of an assessment as to what the possible risk is to the direction of the trend trading. To come to a consensus in my practice that here we've got a trend that exists in the SPYs, the IWM, and the Q, and these are the potential risks to that trend. Now I'm ready to go on and look for stocks. And the first step you can take then, if you want to cut down your universe quite a bit, is to then look at sectors within the marketplace to determine what sectors are stronger relative to the market than others. For this, it can be just a simple assessment using the Select Spider series, the XL series. There's 9 of them to give you 9 different sectors to take a look at. Each of these sectors measured relative to the S&P 500 or relative to the IWMs or the Qs can give you a quick trend assessment as to which sector might be the one or two that are the best served for looking for individual stock trade opportunities. You don't have to do that, but it's a definite shortcut. I actually have a universe of about 1,000 stocks, 1,100 stocks that I take a look at least once a week using what I tell my partners is the H2I system, the Harmon's 2 eyes. I do not use any kind of scanners or filters or anything. I just look at every chart myself. So that I've got the possibility of picking up some stocks that will miss a scan or will not be in those strong sectors but still have a strong trend. And what am I looking for? I'm looking for different layers, as I said, of technical analysis to build a mosaic of a positive picture if the trend is up like it is in the SPY. So I look at the classical technical analysis techniques, Japanese candlesticks, what I call derived analysis, things like Fibonacci levels, harmonic patterns, and Elliott wave. as well as what I call price derivatives, which are most of the indicators that you see on charting packages. And I've listed 3 of them here that are the most common, so that they're the ones I tend to look at first, the RSI and the MACD, which are momentum indicators, and the Bollinger Bands, which is a volatility indicator. So with that in hand, I then start the process of looking for stocks. I'm not going to go through and show you all the stocks, but now it's time to get our hands dirty and take a look at 2 that I talked about actually talked about these 2 stocks at a conference last week in New York City. So they're still pretty valid setups, and when I looked early this afternoon, both were still in the process of breaking out. Not quite yet. So let's take a look at first Whirlpool. This is a weekly chart of Whirlpool's stock price. You can see I used the candlesticks on it. And I've cleared off everything here other than a quick classical technical view here to show that there's a symmetrical triangle that's been in place since the beginning of 2014 that's been tightening. The top of that breakout level where the last candlestick is there is at about 154. And if you're familiar with classical technical techniques, the symmetrical triangle, if it is to break out of the top side of this pattern, would look to measure equal to the move at the widest end of the triangle, so about just under $33, projected higher, so move up to 187. This gets interesting when you've got 1, 2, 3, 4, 5 touches now on the triangle, and it keeps getting tighter. So it's got, so we've got a market that's trending higher, and now we've got Whirlpool in a position where it's exhibiting a pattern that if it were to break out, it would break out to the upside for what could be 20% or more based on this pattern. So there's another pattern that shows up in this stock as well, a cup and handle. And I've drawn the cup and handle in here. If you're familiar with this pattern, the prognosis for the move out of the cup and handle is that the depth of the cup to the lip of the handle projected again higher. So it's not as prominent here, but you see the cup. It was a little pullback in the handle, and it's back up at the point where it's about to break to new highs, triggering the cup and handle pattern, which will look for a move $19 higher or up to about 173. So now we've got 2 different types of analysis that are both pointing higher. But it doesn't stop there. Harmonics gives us another pattern here called a deep crab. Harmonics, if you're not familiar with them, are built off of Fibonacci ratios. Carney discovered these, within the last 20 years. These are probably one of the most recent additions to the technical toolkit. What's important about this pattern is that it starts at this point X, pulls back, retraces up about 88.6%. That's the key Fibonacci retracement. Pulls back down less than that 88.6%. And as it breaks above the B point here, it's expected to reach a point 161.8% extension of this initial move, so up to the point D at about 181.6. Oddly enough, this is actually called a bearish deep crab pattern because Carney explains this as the move from X to A to B to C to D as a precursor to a potential reversal back down. But it can also be played as the move gets above B, this point B, as a possible extension up to D. So you can see there's a lot of room there too, 28 points. So now we've got 3 forms of technical analysis all pointing higher, and we layer in the momentum indicators. The RSI, I like to look at the RSI as being bullish above 60 and bearish below 40, but it depends on what direction it moves in. So if you walk back to December and prior to that in 2013, the RSI was bullish above 60. When it pulled back, it never broke 40. So to me, that means it remained in the bullish zone. So the consolidation that's happened all this year has taken place in the bullish zone. It's bounced back up to 60 and back down to 40, but it's never broken that 40 level. And now the RSI, the momentum indicator, is trending higher in that bullish zone. Will it bounce up to 60 again? It might. But it's got the bullish zone behind it, so it's got support for a move higher. You can see the MACD back in mid-July gave a buy signal as well with the cross up, basically at point C. And that's another bullish indicator in favor of the stock. So the full chart now shows 3 different types of technical analysis and 2 derived indicators that both point to the stock moving higher. So this is something that gains my interest now. That is the full mosaic for this stock. Now at this point, you could just trade the stock on a breakout above this symmetrical triangle above 154 and use, maybe something at the bottom of the handle as a stop. So maybe 150 as a stop. So 4-point downside risk against upside of, even on the worst case at 173, I think was the lowest one, $19. $4 at risk against $19 of potential gains is a pretty good risk-reward scenario. But I'm an options trader as well, so I do more from here. I'm not going to spend a whole lot of time talking about options and in specifically what's a call and what's a put. There's plenty of places you can look for that. That type of education. There's a good book in the back of, it's listed in the additional reading in the back of my book if you really need someplace to find, or the Options Industry Council website is a good spot to check as well. But some of the most common uses for options are for stock replacement. So rather than buying the stock, buying a call option that's in the money or at the money. Selling covered calls to get premium, additional income off of stock positions that you own already. Using collars to protect positions. And collars just that covered call, but also with a downside put being bought to protect the downside. We do a lot of that and tend to use more put spreads because they're cheaper. But when I look at how to trade these stocks that I'm looking at with these mosaic patterns, I'm looking for different combinations of options that might be able to maximize my return, create a lot of leverage, and manage the risk at the same time, and get me in these trades for not much money at all. These are some of the combinations that I use. I'm not going to go through each of these, although if you need a practical example, these are all described in my book as well. There's very short examples that are more theoretical at the Options Industry Council website as well. I've got no affiliation with them, but they do talk about each of these. But you can see here that there's some lingo you need to get over once you're moving from stocks into options. Diagonals, calendars, butterflies, condors, risk reversals, etc. I like to kind of not dumb it down, but make it a little more simple. For me, what I'm looking for in an options overlay is just 4 different things. The first I'm going to call a driver, and the driver is the reason that I'm going to get into the trade. It's the one option that I want to own or that I want to sell based on how I've analyzed the chart from a technical perspective. From there, I'll look to fund that trade. So I'll look for another option that I can sell to reduce the cost and or a third to enhance the leverage as well. So that funding may take the position of just one option sold, or it might be a couple of options sold. But once that's done, then I need to reassess whether or not I've created too much risk for the possible reward that's outstanding, so that I may then need to adjust again with another option to manage the risk in the trade. This can kind of be a little simpler than looking at those combinations from this back page, but it's still kind of confusing without some practical application. So let's look at that compared to the Whirlpool trade that we were just looking at. These are the September and October options chains. They're from a week ago, so they're not from today. You won't find these prices today. But if you recall, we were looking at the stock price at just under 154 and going into last week, and these were what the options closed at, the closing bids and offers on Friday night prior to that. What interests me about this stock is that I'd like to own the options for the upside. If I go back to this chart, I want to own options that give me exposure to the upside above 154. So maybe the 155 calls or the 160 calls, and I want to be able to have them run more than a week. So I'm going to look at October. So when I look at this chain, then I've got 2 choices here. I've got these October 155 calls that were offered at $3, and I've got the October 160 calls that were offered at $1.45. I'm kind of cheap, so for me, with a move anticipated on a breakout that it might go to 175 or even 185, I'm going to look at the 160 calls. But then I'm also going to look towards how can I make this even a little bit cheaper for me. And the other 2 options that I've got circled on here, the September 160 calls, I can sell them for 21 cents. So to cut my cost down to $1.24, the 145 minus 21 cents. On the thought that if it breaks out with a week to go, that it might stall at 160 or lower. The reason that I think it might stall at 160 or lower is that I look at this open interest. Oops. I look at this open interest layered here, and it's quite large, between 145 and 160, over 1,000 contracts on each, and close to 2,000 at the 150 strike, but then falls off substantially at 165. So there's a shot that at expiry, the stock might get stuck due to market makers and players hedging their positions based on their options. So I think that if I were to go with the 155s, I could buy them for $3 and sell the 155 September calls against them for $1 and still have a relatively low cost trade of $2. But there's the risk that there's some room above that 155 strike that the stock price might move at expiry. So it's a little bit safer to go with the 160s, especially since our trigger is only at 154. Now the other side's a little more complicated. The puts here, even at $1.20 now, the 145 cost of the 160 in October, less the 21 cents for the 160 since September. The $1.24 for that calendar is still a little bit expensive for me. And looking back at the chart, I see that the entire range of this consolidation, be it a symmetrical triangle or deep crab or cup and handle, has taken place above 135, other than a very brief moment dip down here at the beginning of February. So I feel pretty confident that if it gets back to that level, it would be a good place to own it for another bounce higher. So I'm going to go ahead as well and look to sell the October 135 puts for 35 cents to lower the cost again. That last sale, the put sale, brings margin into the trade. The call calendar, just buying the calls and selling the shorter calls, doesn't take margin. But once you start selling naked puts, now you've got margin calculations in here. Your broker is going to take, it's going to take margin for the downside for that trade. If you're not comfortable owning the stocks at 135, I wouldn't sell that part. So putting it all together then, creating a plan, you've got your potential from the three patterns of going to 173, 181, or 187. Again, we're going to buy the October 160 calls for $1.45, sell the September 160 calls for 21 cents, and sell the October 135 puts for 35 cents. So our net cost now is 89 cents to be in the trade. The risk at that point is the 89-cent premium until you get down to 135, and then it's dollar for dollar. And the upside is on a breakout, the move up to 173 or 187, somewhere in that range. So it's a pretty good reward to risk ratio if you're willing to own the stock at 135. But then the part of the plan is, well, what do you do from there? Well, we sold those September calls expecting that they're going to expire worthless. So what do you plan to do if they don't expire worthless? Well, because if they expire, then you just keep that 21-cent premium. If they do get into the money, then you've got to figure out what to do with that. And my plan would be to roll them up and out. So either to October 165 or to October 170 calls, depending on where the stock price moves to at expiry. The second part of the plan for me then is I'm short the 135 puts, given that this trade is triggered. We'll assume it's triggered. I would be short the 135 puts, and as the stock price moves up, those 135 puts are also going to start to decay in value, both from the theta and from the price moving up. So you've got an option there to just let them sit, and as they decay, buy them back if they get cheap enough, or you can try and squeeze some more premium and create more leverage in the trade. If the price gets up here above 160, you may be comfortable selling the 140 puts instead, so rolling them up. So that's the plan. You can see it's pretty simply written out, but it's written out. This stock, as of today, still had not triggered, so the plan's still valid here. Of course, you've only got 1 day left in the September option, so I'm going to have to reassess this this weekend to determine what to do with just October options, whether or not I want to move the whole trade out to an October-November calendar. So one more to look at. I was also looking at, and this is from mid last week, Facebook. And Facebook, you can see just from a pure price action, has been trending higher against rising support. That's pretty easy to see with an uncluttered chart. you add on the Bollinger Bands, then you get a couple of pieces of information. First, you see that typically when it's hit a flat top, it's bounced back down, and that's happened a couple times. And when it's exceeded it, it's come back through. But you can also see here that as the Bollinger Bands have been turning higher, so they turned higher in this period here, and they turned higher in this period here, and they turned higher in this period here. As they've turned higher, the stock price has ridden the upper Bollinger Band as long as it's been above the midline of it, which is happens to be the 20-day simple moving average. And what's going on up here now? These Bollinger Bands are starting to open up again, and the price has found support since the beginning of August at the 20-day simple moving average. So you've got another volatility screen here that says that it's got a positive view to the stock. This one also has a cup and handle in it, though, which is drawn out here. And you can see that that cup is a little over $20 wide and starting to trigger here on a move over 77. So that takes us up to a target of about 96.50. If you don't like just the cup and handle, there's a measured move here. So we've gone through a bit of a rounding here and a sharp move up, a pullback, and consolidation. Another move up of equal value would take it to at least 85. And then if we throw on the momentum indicators, you can see that the RSI, since pulling back in the start of the cup, has moved up higher, moved up into the bullish zone. And on the last pullback, it didn't break the 40 level that we looked for. So stayed bullish and is back up here again and is holding bullish. The MACD did trigger higher, pulled back and kind of leveled, and just a couple of days before this picture was taken, crossed to the upside, triggering a buy signal as well. So you've got two momentum indicators, volatility indicator, a cup and handle, a measured move, and a rising trend, all pointing higher to Facebook. That's, again, a big mosaic for me that says this thing looks to be moving higher. Creating the options overlay on this, I've kind of gotten some of the noise out of it. This stock does have weekly options. I'm more interested in holding it for the long term. So when I go back to this page here, I see that we've got 77.50 roughly as a trigger point, and upside we set to either 85 or 95. So when I look at the options chain in September, this 80 call strike sticks out at me with 99,000 open interest. There's some size at the 75 strike, but that's below, and I'm not interested in that because if it sticks down around that 75 strike, then the trade hasn't triggered. But when you look at above the 80 strike level, it falls off quickly. So that 99,000 looks to me as something that might be a magnet for the stocks in the coming week. And we have seen it kind of creep up towards that a bit the last few days after the pullback. So when I look for more time for this trade to play out, I'm going to take a look at the October option chain, and I'm going to look at the monthly because there tends to be more liquidity when you go out 6 weeks in a stock that's got weekly options. Tends to be more liquidity when you go out to the monthly options. And this is there's a large open interest at the 80 strike here as well, and at the 85 above. So there's some good institutional buying there that could get the stock going higher. So I'm going to take a look at owning the October 80 call, and as of the time that I printed this out. I think it was Wednesday last week. Those are available for $1.93. And look towards this 99,000 in open interest as kind of a speed break going into this Friday to stop it, to stop the stock price, and sell those for 59 cents to put on a call calendar again. So the call calendar here would be $1.93 minus the 59 cents, so $1.34 to get into that trade. Not bad. If you, again, like Facebook for some fundamental reason and want to own it on a pullback as well, you can look back and see that there's good support in this chart at about the 60 level. We don't have that one on there. Or if you like the handle at about the 70 level, and maybe you want to sell the October 70 calls for 50 cents as well. So for Facebook then, we've got a stock that's got many indicators pointing higher with the potential to go to 85 or even as high as 96. We're looking to buy the October 80 calls for $1.93 and sell September 80 calls for 59 cents to set up a call calendar. The plan now would be, what do you do once those September 80 calls expire? As I said, I cut out some of the picture there so it didn't clog the screen up, but there's weekly calls. So if it stays at the 77.5 level or so, you can sell next week 80 calls and keep doing that weekly. And if you were able to sell them for 50 cents every week, you'd get your money back out of the trade and be in it for free within 3 weeks. But what happens if it keeps moving up? Again, with a call calendar, what I would like to do there is, as it starts to get too expensive to buy back the options outright, and that they're at risk of being in the money, the short calls that is, I look to roll them up and out. So you've got the option at that point of looking to roll them out to October, either October 3s or October 10 expirations at a strike higher than 80, or create just a straight October call spread. Now, if we want to look at some live data, I'd say we were already in this trade and we could buy back the September's 80s at 60 cents. Well, you could, as of that day, sell the October 85s for 69 cents and be in a $5 call spread. And that transaction paid you a credit to do so. But that's the general idea. Those are a couple examples on how you can use technical analysis to create options trades. But I think a lot of people from that point on think they're ready to go, and this is probably the most important part of the plan, and that's position sizing. Your position size needs to get tied into your stop loss. So if you think that there's a $5 stop loss, then you need to understand how much you're willing to lose and position your stock trade based on that $5 loss. You know that as an options trader that the stock can always gap down, so it's not a guarantee that you're going to be capped out and stopped. As an options trader, you can look at the premium that you put in on long options as your stop loss. Worst case, assuming that you're going to lose it all, and position size around that. Now, in some cases, you know that you're not going to lose full value. If you've got an option that's $20 in the money, it's unlikely that it's going to lose its full value. So you may have a stop loss on your option as well, as opposed to just based on the stock price. But the point is that your stop loss and where it is versus where you're buying the stock need to be a big part of your plan in determining your proper position size so that you can sleep at night. I've got a couple clients that I've been talking with the last couple of days that have had very large positions in Apple and Twitter calls. As the stock's been jerked around in this last week in options expiration, have finally come to the realization that their size was too big because they couldn't sleep at night, knowing that a 40-cent move in the option was going to be something that could ruin their account. So think about that ahead of time. Finally, just a couple things to give you a little more detail about what I do day to day. The Dragonfly Capital Service, you can learn more about it at my blog under the Premium tab at dragonflycap.com. But it starts out on Friday night with a weekly technical review that goes through that top-down analysis on a macro perspective, as I said. I give out 10 trades on stocks and options overlays on them where there's liquidity and it's appropriate each Sunday. Those come with entries, a trigger for the entry, a target, and stop losses. Something that we didn't talk about today, part of that service as well, is daily earnings plays. So using options for event-driven plays. And maybe I can talk about that at another time. If you're not interested in doing it yourself, presidiumcapital.com, send us an email at info@presidiumcapital.com, and we can talk to you about us managing your money for you. Between myself and my partner, Del Nunez, and Tommy Lackey, we've got a lot of financial experience. And finally, actually, I will not be signing books because I'm not there with you. But if you are interested, I do have, you can get the book. It's available at Amazon. There's ebooks as well. My friend Ralph Acampora did a nice intro for me, a nice forward for me. And if you hit me up, Greg at dragonflycap.com, I've got a bunch of stickers from Wiley, the publisher, that I can sign them and mail out the sticker for you to put inside your book, dedicating it to you. That's all I got. I'm open for questions. I need to figure out how I can see questions, though. I guess I need to.
Yeah, there's a chat panel. I don't really see any questions for you, though. How long does it take you to go through all those stocks? I think you mentioned over 1,000 that you're looking at.
Yeah, the process for me, you can look at my son practicing golf. He's actually out golfing now. The process for me takes a lot of the day on Saturday. So as I said, I start Friday night looking at the macro view. Usually got something out to customers at 7 o'clock or so Friday night if I'm not going somewhere. And Saturday takes about 5 or 6 hours to run through all the charts to take a look at them. Another 2 to 3 hours to then get the particulars for the 10 stocks that I'm going to use for the week and to write out the trade ideas. And those usually go out early Sunday morning.
Wow, that's a lot of charts to look through.
Yeah, it's I guess it's what you get used to, though, too, right?
Yep. So we do have a question. Stephen asked, can we request technical opinion on our own list of stocks, i.e. would that be part of your paid service?
Yeah, there is a fourth piece of the paid service, and that's email access to me. You can see from the 2 trades that I showed you that I'm not a day trader, so I'm not all that active, and I don't have a chat room. But I do have subscribers that come to me every day and ask me questions about the stocks that I've recommended, as well as ones that they see from other traders or that they've got an idea on. And that's part of the service, is being able to talk about your ideas too.
And Stephen asked, do you hold your picks through earnings?
I hold many of them through earnings. And I mean, the short answer is it depends on the particular trade that I have on and the stock setup itself. For today, I had put on a trade for Red Hat back in June for their earnings and had continued to run it higher. But running into earnings tonight, I liked the stock higher, and I found myself in a short call spread going into earnings and opted to close the trade. So that's an example of not wanting to hold it through earnings for the risk that was left in the trade. But I've got plenty of long-term positions that I will tend to use collars on to protect them through earnings as opposed to taking them off if I still like how the chart looks on the stock. So it's a risk-reward thing. If there's a way to protect gains and to protect the position for the continued setup and movement in the stock that I see, then I will do that. If that protection is too expensive, then I might take it off. And if there's no protection, then I probably will take it off.
Right. Jim just said Alibaba was priced at 68 for those who are waiting for the price. We had a presentation from Jim and his trading partner Ian about how they traded that for the last 2 months, and Yahoo is really interesting.
Yeah, I think Yahoo's actually a pretty interesting stock now because to me it seems like the sentiment for Yahoo is strongly to the downside following this Alibaba IPO. But the chart says that it's got massive upside potential to it. So right. I think the next few weeks in Yahoo will be pretty interesting.
And we had a nice compliment for you. Venki says he's a subscriber and he loves every inch of your thoughts and trades. Great mentor. This is the 3rd year of association with you, so he thinks it's worth every penny. So thanks for that.
Thanks, Venki.
And Stephen says, can you give thoughts on CMG rounded top pattern right now?
Let me open it up to take a look. I had shut down the charting software because it makes noise. So it's just going to take a second to pull it back up.
Hmm. 50-day support. MACDs look like they're turning around. The RSI looks like it's turning around. So with things like the Williams % R and CCI. It's got an ugly gap though.
It does have a big gap underneath it. But I would say that I like, see if I can make it big enough to actually see here. I like this hammer candlestick that happened yesterday being confirmed higher today. You can see the RSI dipped down below 40, but has bounced back up quickly. The MACD is not there yet, but it's leveling. Let's add accumulation on this. You can see accumulation is still strong.
I know that you use SMAs, but the EMA 50 looks like it's also been a great support and is touched it a couple of times.
Great. If you take this to a weekly view, this weekly candlestick looks like it's going to be a nice hammer. So if you're a longer-term view on this, it still looks like a solid stock. If it can get over 680, has a lot of upside to it. The accumulation distribution on the weekly scale looks very strong. playing out to the monthly, maybe a little bit overbought, but still fairly strong. To me, it looks like if you put all that together, a long position against the bottom of this hammer at around 650 has probably the potential to get you back up to the 685 level. So with the stock closing today at 664, that's 15 downside versus 20 upside. I don't know if it's a great risk reward. If you want to keep it tighter than that, maybe. But it looks like there's potential for a lot more upside if you were to break above that 685 level.
Greg, can you comment on your thoughts about the gap?
The gap in this chart or GPS?
No, the gap in the chart and gaps in general. Are you a believer that gaps fill?
I'm a believer that some gaps fill, but they don't have to fill. But if you think about what I just said, using 650 as a stop, I'm saying that you don't want to own this stock if it's starting to get into that gap.
Yeah.
You can see here that the Bollinger Band's really squeezed, and you can see them squeezing here again. And that has led to strong moves in the stock before. So you've got this long run here, and you've got the big gap up higher here. You've had this big squeeze again, and they're starting to expand. So today's candle could be just a fake out as this continues to roll down, fill that gap. So I don't think you want to be long the stock up under 650.
Yeah. No, I agree. The thing is that I normally think that usually I think most gaps tend to end up filling, but if in Chipotle, there's a good example back in the earnings of the third quarter 2013, where they had a gap and it actually ended as support. You see right there on the left-hand side of your chart.
Mm-hmm. Yep, you had
exactly, we hit it twice. Exactly.
Yep, so this gap did fill, but this one's still open.
Yep. So you got a couple of gaps that haven't filled, but it's a...
Mm-hmm. Yeah, I think it makes sense to know where the gaps are and to know if the price starts moving into the gap, what you're going to do about it. And generally, you don't want to be holding the stock as it's moving into a gap going against you. But I wouldn't go to the extreme and view that every gap is going to get filled. I wouldn't stay out of the stock right now because there's a gap below it, but I would make sure that I had a tight leash on it.
I think your comment about having a written plan is an excellent one, and one that our listeners should really take heed to. Tom, any other questions we have?
Guess that means no.
I was just thinking the same thing. Okay.
Okay, everyone. I've got a family school picnic tonight, but I sit around and watch some baseball games every night with my Samsung tablet and answer emails and stuff. So if you find you have questions, you want to get me on Twitter or at Greg at Dragonfly Cap later on, feel free to do so.
Greg, thank you so much for your time. We really appreciate it, and we look forward to speaking to everybody on Monday when we end up doing our weekly recap. Greg, just one last time, okay, if everybody ends up seeing, if they want to end up getting in touch with you, what's the best way?
Via email, right here on the screen here, greg@dragonflycap.com. I'm active on Twitter. You can get me at Greg Harmon. I have the same handle on StockTwits if you use that as well.
Thank you so much. Have a good evening.
Thank you, guys.